You guys, you gotta start yapping now, if that's okay. Yeah. Wait. Yeah. No, I just have the timer so that like my laptop doesn't die, so that my phone doesn't die because it's charging right now. What do you guys remember from last time though? Mm-hmm. Or no, not last week because we did a game then. The week before there. Yeah, we talked about the mechanics of the stock, right? How a stock moves. Today we're gonna talk about how like options move. They are determined. First, let's review what an option is. Option, if it's, or I guess we'll do what we were saying before. It's a claim on 100 shares of a stock at a certain point in time. This is only if the stock reaches a certain goal.
So you don't have to buy an option if it's below. It's the ability to buy.
It's the option. An option is the option to buy.
Versus a future where you have to buy, right?
Futures is a little bit different. We'll get into that probably next meeting. Anyways, so what can we infer based on this statement here? What determines the price of an option?
The stock value,
Stock price,
length of option,
lifetime of option. Stock price,
key interest rate, probably.
lifetime. No, just from this statement right here.
Yeah.
There's one more. Yeah, there's one more we can fish out from here. The stock reaches a certain goal.
Oh yeah, difference.
Certain goal. Let's just. This, let's just say, initial stock price. We'll give the stock price a variable called SO. Lifetime of option, let's call that T. Certain goal, it's called a strike price. Once the option strikes that price, that's when you start becoming profitable. So that's kind of a cool way to think about it. Like it strikes that price, basically. We'll call it K. K, what the hell is that? K is a strike price. There are two sort of hidden ones on here. You mentioned one of them, Daniel. You mentioned one of them, which is the interest rate. Interest rate. Let's call this R. So we have S, T, K, and R. One last one that's, I don't expect anyone to get this, but there's one last one, and it's really important, and it's based on the market. Yeah, volatility. Volatility. Okay, I'm gonna use a weird symbol for this. Alpha. It's like an O with a tail, right? Volatility is just, it's super simple. It's just how much the stock moves. So let's just say, on average, in one day, let's just say this is one day, it moved 5%. The stock moved 5% price. So the volatility would be 5%. What's up?
If the stock moved from like 0 to 20 or 50 and then went back to 4 or something, like a ridiculous jump, but before the time period ended, it goes back. Will that have a higher or low volatility?
High.
Okay.
Very high.
It's like the maximum change almost, right?
Yeah.
Okay.
Yeah, that's a good way to think about it, the maximum change. These 1, 2, 3, 4, 5. 5 things that determine the price of a stock. I'm gonna do something weird here.
Price of an option.
Or price of an option, I'm sorry. So we can say this is for something called a call. We're gonna get into that later. Just know the option we're talking about here is called a call.
That's it going up.
That's when you're saying it's gonna go up. I'll get into that after this. So call is determined by some sort of function based on all these variables. Is that okay? It's just a function based on these sort of variables. If you want to know, it's called the Black-Scholes equation. It's super complicated. I don't even remember what it's called, but it's based, these are all the variables in it. So S0. Yeah, that was the thing on Desmos, but not right now though. So stock price, lifetime of option, strike price, interest rate, and volatility. This is the mathematical model behind how options are priced. Go. I'm gonna send this over here. So C, price of a call is equal to a certain function based on the strike price, time, or stock price, time, strike price, interest rate, and volatility. Have any of you taken any sort of calc yet? You're in Calc 3, yeah.
I'm in trigonometry.
Oh, yeah.
On Calc 1.
No, you're not in anything, are you? So, the partial derivatives of these. So, basically what a derivative is it's modeling the change in this based on the change in this. Or this, or this, or this, or this.
Well, the change on one. But the thing is, this would be like a five-dimensional curve. So the change of one axis of this curve.
Yeah.
Okay.
Well, I mean, not necessarily 5 dimensions.
It's 5 variables, so like 5.
Yeah, but I mean, all these, this, and this, they're given to you. Wait, what were you saying?
Actually, some of those, I know. Never mind.
What were you saying?
Some of those variables, I mean, they're not connected, actually.
They're not necessarily connected.
Not necessarily. But, I mean,
they're connected through options, which is how they're priced.
But some of them you wouldn't want to measure exactly when taking the derivative. Like, you'd assume, like, the interest rate is constant, right? Because you don't want to...
Interest rate is constant, yeah.
Volatility is generally constant.
Well, not necessarily, actually. Here, we'll get into that later. But sort of the thing I want to point out here is that, let's say you want a numerical value for how the price of this changes based on the price of this. So let's write that down. So how the call price changes as the strike price or the stock price changes. Right? How this price changes as you change this variable. So like, for example, let's just do some sort of regular function, 2x. If you wanted the change, how y changes as x changes, what do you guys think that is? Like, if x is 1, y is 2. If x is 2, y is 4. If x is 3, y is 6. So y changes by doubling as x changes. So y doubles every time x changes. So we would say the derivative, this is like the derivative sign, is equal to 2. So y changes by 2 as x changes, pretty much. Same concept here, except like wider scale, but it's not too complicated. So how the call price changes as the stock price changes. Since there's multiple variables here, we use a special notation, this curly D, pause. Anyways, so the price of the call as the price of the stock changes. That's this.
It's a partial derivative.
This is a partial derivative. And we can just keep going.
Is the partial derivative of the call or the partial derivative of the stock price?
No, this is basically saying this.
So
Oh, yeah.
this one, it's respect to the y of the function. It's a
Partial derivative of the call in respect to partial derivative of the stock.
I have a question. Think about it this way. Imagine like a really wavy, crazy function, right? You take the derivative in respect, it's a 3D function. You take the derivative in respect to the x-axis. It might be flat. You take the derivative in respect to the y-axis. It might be down very quickly. So it's different values. Yeah. Okay, that's what's basically going on.
Anyways, so we got this, the change in the price as the stock price changes. We can also do the change in the price as the time changes. So as time gets closer and closer, how does the price change? Or as it gets farther and farther away, how does the price change? So that's this. The change in the price as the time changes. Is that okay, everyone? Furthermore, we actually don't use this, the strike price and the call price. Like, it's not important. But this, the change in the call price as the interest rate changes, right? The change in the call price as the volatility changes. Any questions?
Are you talking about this interest rate in America? Or
Yeah, pretty much. Just that it's not really. Interest rate is just a model for economic growth, basically.
so
And
if
this
Jerome
is
Powell came up and lowered interest rates, will all the options go up?
they will all go down.
Okay.
Yeah, because higher interest rate means higher call price. Like, a call price is proportional to the interest rate. It's proportional to all of these. If it was to go up, the call price would have to be the inverse of this. So as this goes up, the call price would go down because this is a lower value. What's up?
I'll explain quickly. The interest rate is how much money banks can get by loaning money to the federal. Basically, banks can either loan you money or they can loan money to the federal government. If the federal government hikes up the interest rate, all the banks are going to want to loan money to the federal government because they get more money. The interest rate is how much money you would get by basically putting the money into a. It's how much money you get in interest. Yeah. So you put $100, you get $5.
No. He knows what the interest rate is. He's just asking, how does that affect the call price?
Just because if the interest rate goes up, people ditch this stuff and go into federal securities.
That's the economic way of looking at it. But that's for stocks. For options, it's literally a mathematical rule that a call price is proportional, not necessarily equal, but it's proportional to all these values.
That's because if you have a higher interest rate, then money in the future is worth less than money. It's going to decrease the time value of money.
That's still an economic way of looking at it. That's what the developers of this function were thinking.
Okay.
But now that we have the actual math behind it, we can just say this is a general rule.
Okay.
Anyways, so we have the change in the price as the stock price changes, as the time changes, as the interest rate changes, and as the volatility changes. We have names for all of these. This we call delta.
Yeah, I've seen that.
Mm-hmm.
And gamma.
Gamma, yeah, I'm going to add gamma in here in a second because it's actually the partial derivative of this. But this is theta. I don't know if you've heard of theta decay. Yeah, theta. This is called rho, R-H-O. This is not really important. This is called vega. V. All of these, what do all of these have in common? What do all these names you think have common?
Greek letters.
That's why we call these Greeks. These all are an effect of the call price. They're not necessarily what prices the call. They're just effects of the call price. What prices the call is the parent functions or the parent variables, which are these. So what prices the call is this, stock price, time, interest rate, and implied volatility. I'll add another one to these. This one. This is, think about it, we're doing this twice. So we're getting the change in the stock price. This is going to be really confusing. We're getting the change in the call price as the change in the call price of the strike price or the stock price changes. So it's literally how the call price changes as delta changes. And we call this gamma. Little bar symbol right there. And these are all the Greeks. I wanted to touch on this implied volatility right here, because what is that? We don't really know what that is. Just get this up here. So we said call is equal to some sort of function that is based on the strike price, time, or stock price times strike price, interest rate, and I'm just going to say IV, implied volatility. What is given to us in this function? If you were to look at an options chain like we did last time, we had some sort of values. Do you know what those are?
Stock price, time, and what's next again?
Strike price. Strike price. We're also given the interest rate. That's just a regular variable. What?
It's known information.
Yeah, it's known. And if you think about it, we're given this. We're given the call price. If you were to buy a call, you know how much it's worth. So you know the call price. We're not given this, though. This implied volatility. And so this equation helps us solve for this implied volatility. Now, what is implied volatility? IV. Basically, it's how much the market thinks the stock, not the option, the stock is going to move in this amount of time. So let's just say 30-day.
So it's a prediction of future volatility, not past volatility.
It's not a prediction. It's a numerical value of how much the market thinks the stock is going to go up or down. I mean, it is sort of a prediction, but it's like it's not one person that's predicting. It's the entire market.
Yeah, okay.
It's the entire market based on the options market, what they think is going to happen to the stock. And so it's kind of a clever way to think about it. The 30-day implied volatility, let's just say, is 50%. So in 30 days, if the implied volatility is 50%, that means that the market in general, the market participants, everyone who's buying and selling that exact option, thinks that the price is going to move 50% in 30 days. Does that make sense? Yeah. Anyone who's traded the market knows this is super like overblown. It's not like this at all. It could be, this value could be true, and it is true a lot of times in the options market, but it never happens in real life. This is why we call it an implied volatility. It's not an actual volatility. It's the implied move based on how the stock is, how the option market is going. So based on everything over here, based on all these, we can tell how the market participants are thinking, basically.
So when it says 50%, they think that the market's going to go like flying up and down, basically.
They think, they think that,
There's a lot of uncertainty. Trump could put like tariffs or something.
yeah, that's a good way to look at it. But it's only in the up direction if it's a call.
Okay,
So
well,
they think that it's going to move up 50%.
What if they think it's going to move down 50%?
And then it's going to be a low implied volatility.
Okay.
I mean, no, not necessarily. I mean, it depends on all these other things, though.
Okay.
Yeah. But no, you're right. It is sort of a measure of uncertainty. It's good that you brought this up. They think that it's going to move 50% either up or down in 30 days. It doesn't matter where. They just think that there is going to be a move. The total move of the stock in 30 days is going to be 50%.
Very high. Okay.
No matter if it's up or down.
Okay.
So we can do something with this. If we take 5 volatility and divide it by the time of the strike price, or the option, we get, let's just say this was 30. 50 divided by 30. 2.6.
Profitability-wise, can't you see like what's more beneficial to buy?
What do you mean?
Because like if it's a higher implied volatility, right? Then like it's like it would be more worth it to buy.
Well,
Less worth it to
yeah,
buy.
there's a higher chance to make a profit.
It depends. But
Because here it literally gives you like the implied volatility and like.
But if your volatility is zero, you're gonna lose money on the option.
yeah, no, I'll get into that. Not necessarily.
Okay.
So let's just stick with this for now. They think that in every single day, up until 30 days, the stock price is going to move 2.6% every single day.
That's like in a perfect world.
That's what this option price is implying. So exactly. So it's like you can trade this difference. You can trade this difference if the option market is thinking that there's going to be some sort of movement, and historically it hasn't been like that, then you can profit off of that. And I'll get into that right now. What's up?
I have a question. The market's saying that every day there's going to be a 2% change in the stock price. But over just mathematically, if it was randomly upward, is this you're saying every day is going to go on average 2% upwards?
Yeah.
But you're saying this
No, that,
Are you talking about puts as well?
well,
I guess.
okay.
The thing though, obviously, if it's saying randomly 2% up and down, it's going to average out to 0. That's just basically.
Well, not really. If you have a 2% up, then 2% down, and then 2% down, 2% down, 2% down, 2% down, 2% down, and then
the average, 2% with 50% odds on each side, that's going to average out to 0. That's
how will it average out to 0?
if it's 50% of a chance that 2% goes. Okay.
This isn't a 50% chance. This is a 50%
If there's a 50%
total move.
chance that it goes 2.6% up, and there's a 50% chance that it goes 2.6% down. Is that what you're saying?
No.
No. So what are you saying?
I'm saying
So I thought it was on average per day increases on 2.6% chance. It could be 5, it could be 0, it could be negative 15, but if you add them all up, it's supposed to be about 50%
Okay.
in total.
the market price, let's just say a call was worth $100. Call is worth $100 today. If we plug it into this and we plug in all of these variables, we get that this call assumes that the implied volatility is going to be, let's just say 50%, which is high,
But you're saying this can be up and down, just to make sure.
Here, wait, let me just finish. If we know that the realized, see, I have implied and realized. This is the historical average. If we know that the realized is like 10%, which is true, it's the true value of the volatility. That means that this call is too expensive because it's too high. It's higher than the average. So we can say that implied volatility is higher than the realized volatility, which means the call is expensive. If the implied volatility,
It's too expensive.
it's not
It's
worth,
overvalued.
it's overvalued. There you go. If the implied volatility is less than the realized volatility, that means that the call is cheap. It's undervalued. And if they're equal, then the call is true. It's the true value of the call.
I understand. Can I ask a question?
What's up?
Let's say, so my assumption with this 50% is that the investors predict over this 30-day period, for example, it's going to move 50% one way or the other. Would that be correct? One way or the other, meaning either up or down, but it's going to move by 50% and not by 0% or 5%. That's the guess, right?
Well, I guess that's one way to look at it. The way I like to look at it, though, is that this implied volatility is it's a numerical sum.
That's what I think.
Of.
So my assumption, I just want to make this clear.
What's up?
I'm clear about this. So let's say your investors, day 1, it goes up by 3%, day 2, it goes up by 4%, and then for the rest of the month, it goes 0%. Your investors would realize at some point, hey, this volatility is overvalued for the month. And they'd be like, okay, it's not growing at the rate it should be to get to 50%.
And then the call price will reflect that. The call price would go down.
And say they would dump it because there's a less chance that they actually get the option to pay off. Okay.
Pretty much. Is this okay for everyone? Does this make sense? Any sort of?
Okay. And just
So.
one more thing to be sure.
Yeah.
My assumption was that you want the stock to increase by a certain amount. And so that the higher the volatility, the higher of a chance that it increases by a certain amount.
Well, we're actually going to get into that right now.
Okay.
I'm going to draw this graph. Here, we have time. Here, we have volatility. I'm going to, in dotted lines, plot the implied volatility, which is what the market thinks is going to happen. In a straight line, I'm going to do the realized volatility, which is what has actually happened historically. It's going to be random, but let's just say. Oh, shoot. Wrong one. Whoopsies. This is the realized volatility. This is the implied volatility. This is what the market participants think is going to happen to the stock. And this is what has actually happened historically. What if we know?
Isn't that kind of like, can't you just use that like a standard deviation? Because you can see like how much it deviates from like the average.
Mm-hmm.
Yes.
Yeah. So if we know that when the implied volatility is higher than the realized volatility, then the call price is too expensive. So let's think. Over here, if the call price is too expensive, what would you want to do to profit?
Too expensive, then
To buy it at a little
short it.
You short the call, you sell it. You sell a call.
You sell a call you don't have to buy in the future.
Yeah.
Okay.
You sell a call that you'd have to buy in the future, and you're hoping that
Or you can just do puts, right?
no, you can't do that because the puts are going to be expensive too. Because this here is for calls and puts.
So yeah, puts are the opposite, right? They're when you think the stock is going to decrease past.
Go down. I'm going to talk about that next, actually.
Okay.
Anyways, so over here, it's logical that you'd want to sell a call because here, the implied volatility is higher than the realized volatility, which means if the implied volatility were to average out, go back to the mean, then the call price would come back to true. And so your overvalued call would go back to true value. Your expensive call would go back to regular price. And if you sell an expensive call, you can buy it back for its true price and you just profited off of that exchange. That makes sense, everyone?
Yes.
We can do the opposite here. If the implied volatility is less than the historical volatility, that means that your call price is cheap. Calls are cheap right now. It's a bargain. Buy it. When you buy it, it's going to go up to its true value, and you basically bought a call on a discount.
So that's how markets estimate kind of the true volatility.
Yeah.
By buying when it's low.
Mm-hmm.
What
I actually made like one hell of a trade on here, low key. It was when this was down, and then it like soared up, and then like I profited a lot from that. What's up?
Did you use like more of like a mathematical approach, or did you just use like a technical approach?
I did both. I mean, I didn't really do like some sort of that algorithm or
Use, like,
whatnot.
a mathematical approach in a real situation.
Yeah. So this stuff is widely available. You can calculate this implied volatility because
Implied volatility, like, you know, when you're trading, like it shows implied volatility like percentage like on the thing.
it does.
Yeah.
Yeah. But that's based on this function right here. We defined a function. It's called the Black-Scholes. I'm not going to write it down though because that's too much math. And so you can literally, this is a closed form function. So, and you know all of these things. You can make an algorithm that plugs in all of these things, finds this, and compares it to the historical, and then it just trades based on if this is up.
Wait, so it's basically like you can use it to like, so one of the ways you can use it is just to like calculate like implied volatility and use it as like a deviation. Use like what was the other one? The related? Is that
What? Oh, realized volatility. The true
Let's
volatility.
use the true volatility like as like a standard, right?
Mm-hmm.
And then the applied volatility like deviates from the like depending on that deviation it places trades like that. Right?
Mm-hmm. Yeah, pretty much.
It's kind of you know like RSI and stuff.
Yeah.
Like the indicators.
No,
Like
it's something like that.
Yeah.
Yeah, but RSI is for stocks. This is for options.
So because fundamentally the volatility is how much the stock price, going back to like the basis, how much the stock price would change over time.
Yeah.
Let's say I looked at a stock and said this stock, I don't know, it's always going up and down, but at the end of the day, it's like averaging out to zero. Like this, and volatility is like 20%.
Okay.
And then you do this math formula and gives you 50%.
Mm-hmm.
So you kind of look at it from two angles. Will the presumption be that you can make money off this if you look at it outside of the model?
So if
Off, like, real data?
if the true volatility of the stock is 20% and this is saying 50%, then that means that your call is going to be expensive.
Okay.
Not necessarily that the stock is going to be expensive, because this function doesn't give you anything about the stock price.
Okay, the stock price is determined elsewhere. Okay, sure.
Yeah, the stock price is determined elsewhere by market participants, and that's more of the econ standpoint.
We should go into that probably.
Yeah, I mean, I did last time.
Maybe.
That's what we did.
So like if a company is about to have like an earnings call, for instance, like would there be a higher volatility and that would make the
Yep.
stock or the call or option more expensive?
Yep. So actually, I can do it here. During earnings, let's just say this is earnings time.
But volatility doesn't like tell you which way it's gonna go. It just tells you the like.
Is volatility?
Yeah, volatility
It
just tells you
the amount of like activity that will be.
amount of activity. Yeah,
So
exactly.
it's always positive, right?
Yeah.
Okay, well 0 to positive. Okay. It's always
Anyways.
0 to 100.
Yeah, back to your question. So, when regular participants, people who don't really care about this stuff, don't really care about the Greeks, which is most retail investors, they go in and they see that, oh, this company's going to have an earnings call and they're going to do really great on it, and I really want to profit from the option because, as we did last class, option gives you the right, a claim on 100 shares. So they're like, oh, like I can make a lot of money from this. And then they put in a bunch of money into this without even thinking if it's expensive or cheap or just like regular. So what you get from here is that, the implied volatility goes higher and higher and higher as the earnings date approaches. After earnings are done and people come back to reality, there's a huge spike downwards. Even if the stock price boomed up, the implied volatility, it was never going to be 100%. The stock would have never went to 100%, right? Maybe even if it moved 20%, that is a huge step downwards from what the market was implying. And so even if you had theoretically made money based on how the stock would have moved, right? Because a call is also based on the stock price. So as the stock price goes up, your call makes money. Even if you theoretically made money off of this, you still lose money because of this, because the implied volatility sunk down. And so that's what people think, like, that's what they call, what's it called? IV bomb or something. That's what they call it. I can't remember what it was called. But this sort of way that the stock price or the implied volatility just plummets after an earnings call is based on what's up?
As a function of time, there's less uncertainty at that particular moment.
Exactly. There's less uncertainty, and you already have the true value of, you already know what happened on earnings day.
Okay.
Like, so it's
always uncertainty in any company, but there's less than previously.
Yeah.
Okay.
So just think about it. If I am just in love with Fairlife, if I'm just in love with Fairlife, right? And they're having earnings coming up, And I'm like, oh my God, I really think Fairlife is going to do amazing on these earnings. They're going to make so much profits. They're going to make so much whatnot. And I just keep on buying calls, not really looking at this. And let's say Fairlife does end up doing well. They do end up going up. But I just kept on buying and buying and buying and making this call go up and up and up, which makes the implied volatility go up and up and up to the point where it's impossible for Fairlife to ever go up 100% in one day. But I don't care about that. I love Fairlife. Like I want to give money on it. I want to bet that they're going to have a huge move without looking at all of the other consequences that go into how a call is priced. And then Fairlife does good, but it doesn't go 100%. It maybe only goes 15, 20%, which is still good. It's still a good move if you were to buy a stock. But now I've made money on this, but I lost money on this. And the loss on this is much greater than the gain that I got from how the stock price moved up. And so I ended up losing money.
So you're betting specifically with this for a big swing. If you think the company is like solid and it's going to stock is increase, you can just buy the stock, right?
Yeah. In earnings, if the implied volatility is super high like this, then just buy the stock.
Yeah. Well, if you think the stock is going to go up in general, you can just buy the stock and make much more confident money than
Confident money.
a particular increase in a particular time.
Exactly. Another thing you can do is just when it's at low volatility and earnings are coming up, just trade right until before earnings.
Right,
So that you profit from the implied volatility.
Well,
You don't know how the stock price is going to move, but you know how the implied volatility is going to move, because implied volatility tends to go up as earnings date approaches. And so you can just buy a call at this point, hoping that the gain you get from the implied volatility is greater than the loss that you get from this and all the other things.
But essentially, you don't want to sell it before after earnings.
You don't want to sell it after. No. You don't want to sell it after. You want to sell it right before.
Right at the top.
Yeah.
Wouldn't that be priced into the market though? Because everybody knows what earnings day is.
It would be, but it's priced into the market based on how, like, market participants, how informed market participants are.
If they don't know when the company's earning day is.
No.
what's going on.
If they for example don't know or don't care to look for the realized volatility.
Okay.
You know what I mean?
I
Or
understand.
they don't care about any of these Greeks, which is most retail investors looking at options.
Why are they buying off? Okay.
Why are they buying options? That's a great question.
Why are they buying options if they don't care about? Okay.
That's a great question. You better ask them, bro. What were you saying?
I was just saying it's probably the hype, you know?
Yeah,
People bought it for
it's hype, exactly. And options, I think they were like booming like a year and a half ago.
Like they increased all like before like earnings or like like FOMC or whatever.
I mean, they probably increase in trading volume.
Yeah,
It's
those.
like not even worth it to buy because you're gonna put in like so much money.
No, exactly. That also goes into it.
I think I get it. An option is like basically a lot. It's a ticket saying I think there's going to be a big swing in the stock price. If literally nothing is going on, then why would you buy a ticket saying there's going to be a big swing in the stock price? Obviously, there
No,
could be
exactly.
randomly, but there's
Exactly.
a low chance.
Yeah. Why would you do that? Why would you do that? That's a great question. But I mean, that's just the reality of the market we're living
That's
in.
like kind of insider trading. Like the company's going to get sued or something. See why don't you?
But also, I mean, it's not really sunshine and rainbows as we make it out to seem, because quants, what we're trying to be, right, is they're already doing this and they're factoring that in to the call price and they're balancing it out as much as they can. And sometimes they mess up, sometimes they don't.
So would you look at calls for like a very small company? I mean, I guess if you had like a very small company, nobody knows anything about it, and you'd buy calls because nobody knows anything about it, so you can just make money.
Yeah.
But you need need a seller though, who would be willing to lose money on a company
Mm-hmm.
like that. So
You do need a seller, yeah. And that's why, like small companies,
you have to go.
there's going to be a higher spread of, what the sellers are selling at and what the buyers are buying at.
Okay.
And so you can actually use that to your advantage or not. And I was actually going to get into that today, but like
Companies with low market
it's 3:30 already. I can keep going if you guys want.
Go.
Though.
We can keep going.
Yeah.
That's the time.
Okay. Here, what? I'll just go over puts really quickly. They're
The exact opposite of this, basically.
well, they're the exact opposite, but the math is almost basically the same. Puts are still a function based on strike price or stock price, strike price, time, interest rate, and implied volatility. But it's inverted. So whereas a call, we said a call is a claim on 100 shares. So let's just do this. Stock price, right here. Can everyone see that?
Yes.
This profit. Let's say you pay some amount of money to buy this call. Let's say, let's call this premium. So a premium is what you pay to get this option, right? Your goal, what you are actually betting on this, the stock reaching, is called K, the strike price, the goal price. And so you only start making money after K is hit. Does that make sense to everyone?
And isn't it a little bit lower because of the premium you have to pay?
What do you mean?
Like, so if you have to put in like $50 in addition to that, right? Don't you need it to go a little bit lower than the strike price? So you have to
Yeah. I mean, we're only saying this is right when you start actually making money from the option. You're net negative until this what's it called? The stock hits this price. And then that's when you start making money. And you only ever break even when the amount you paid plus your goal price are hit. Like that's how much the stock is basically. So once the stock reaches this value, that's when you start actually becoming profitable from options. This is called a call. This is the call profit chart. This sort of slope is 100. So for every $1 that the stock moves, you make $100 profit on your call.
So it's like a lot of leverage.
A whole lot of leverage, exactly. Only if this value is met. Only if the your goal price, the price that you think that stock is going to go to, plus the amount that you paid for this call is hit, and plus some amount. Puts are different. Here, guess to keep the integrity of the labeling. Stock price. How do I say this? I could say it like this. How do I explain this in the way I did this? So you still pay a premium. But now the stock price is going this way. So you're only making money if the stock price decreases. And it's just the inverted version of this. So you have premium, and let's say this is your goal. This is your goal price. And then K minus the premium is your break even. And so it would go right here, like this. And this is the profit of a put. So as the stock price becomes less, you profit off of your put. It's the exact same mechanics. It's the exact same function, exact same everything, except it's inverted. You make money by the stock price decreasing, going towards negative X, whereas over here you make money as the stock price approaches positive X, as the stock price increases. And it's the exact same things right here. Does everyone understand these? I feel like we didn't go over them enough. So delta is the change in the call or put as the stock price changes. Theta is the change in the call as the time changes. Rho is the change in the call as the interest rate changes. This is not really important because it's like it doesn't really move too much. Vega is the change in the call as the implied volatility changes. And then gamma is the change in the call as delta changes. Does that make sense to everyone? There are some pretty cool things we can do with these, but I'm gonna do that next time. Yeah, next time we're going to go over how to actually code these, which is pretty cool. Okay, meeting adjourned, everyone. Thank you for showing up. If you have any questions, just come over.
Thank you for explaining this.
Yeah, no, and if you can actually